I'm Gabriel Perna, the digital health editor at Modern Healthcare. So I guess I do have a little bit of a duty to ask some tough questions of these guys working in the media, but I'll try not to make them sweat too much. But Michael, why don't you introduce yourself?
Sure. Nice to be here, Gabe. Great to be with you. Hi, everybody. Mike Norson. I'm with a firm called Alexandrea Venture Investments, principal on that team. Our remit is to invest in seed and Series A stage biotech companies. Our LP, kind of exclusive LP, is from a company called Alexandrea Real Estate, which is exclusively focused on providing life science real estate and cluster solutions to biotechs from all ranges, everything from large pharma all the way to the earliest seed and Series A biotech companies. I'm also the head of something called Alexandrea LaunchLabs, which is an incubator platform for seed and Series A stage companies. National platform in all the major biomedical markets, but particularly have opened one in partnership with Columbia on the medical center campus up on Washington Heights. Also an alum of Columbia from the business school, so excited to be back on campus, and came to investing in biotech from biopharma. So I was at Regeneron for 5 years and Pfizer for about a decade before that, so excited to be here.
Yeah. Bill?
Bill Taranto, president of the Merck Global Health Innovation Fund. That's Merck's fund that's dedicated to digital and technology. We're a $500 million evergreen fund that focuses across the biopharma value chain, mostly doing growth investing.
Great. So, we're here to talk a little bit about venture capital funding, specifically in New York City. But, before we get into that, Michael, I know I've talked with some folks here, and there are a lot of people who are just starting out on their journey as an entrepreneur, as a founder. And one thing that might help them is understanding the different types of funding avenues that, companies can take. I think VC is something that is synonymous with it, but it's not the only way to build up your company through an infusion of cash. So maybe you can explain a little bit, what are the different funding avenues that companies can take?
Yeah, so big proponent of VC, but that's a bit of a self-fulfilling prophecy. I'd say one thing in the biosciences in particular, whether that be pure therapeutics or digital health or healthcare IT, being able to use public funds to fund that research is really important. In the kind of our, the federal government being able to continue to increase funding, whether it be through the university setting or things like SBIR grants. I think those are particularly important to be able to use to validate the technology. So, venture firms like, Merck's Global Fund and ours and many others are able to kind of leverage that early work that you've been able to do. The other thing is you generally be able to have the funds to dictate kind of the research and translating that research the way that you might want. So I think those are kind of the earliest of mechanisms that we look for. They're also validators, to be quite honest with you. If you've gotten those grants, there's generally a pretty good group of people deciding who gets them. So generally that's a big of a validator for us as well. The other thing that I think is maybe less well known, but I think is really great is there's lots of not-for-profits and foundations, particularly around specific disease areas, that have both grant mechanisms as well as venture funds as well. Kind of rinse and repeat on what I just said. I think they're very focused on being able to provide not only just funds and validators, but they generally have disease area experts or clinical experts around the table that can help guide the research, and also really good advisors or advisory board members to your company. So certainly would encourage those two as alternative kind of venture models. There's things like venture debt and other things like that, but early stage companies, we really like to see those as starting points.
Yeah, a lot of different options that I'm assuming oftentimes when you're meeting with companies might not even be aware of, what they have available to get out of those early days with a little bit of funding.
For sure.
Bill, the startup ecosystem has gone through, I think you and the others were talking about earlier, it's been a bit of a roller coaster ride the last couple of years. What does that ecosystem look like for startups, and especially here in New York City, as a lot of the people here, I'm guessing, are based in this area?
Yeah, I think what's great also, first about what's great about the ecosystem here in New York is they pull from the tri-state area. So it's much bigger than actually what one might think. And it includes, what I like is every part of the staged ecosystem from you have really early seed capital all the way up through growth capital with IDO, even up to sort of M&A, right? The entire ecosystem works here. But as we were talking earlier in one of the panels, there has been, because of the economic downturn in the last couple of years, what we've seen is those companies in this area that are more in the growth stage are more struggling to raise capital versus the earlier stage, partly because the earlier stage aren't asking for as much capital. They're newer. The growth companies mostly raise at valuations, unfortunately, in the last few years that were not supported by their P&L, and that's caused some economic problems for them in raising the kind of size amount of capital that they're looking to raise. But the good news, I think, for this area, though, is if you're a pure startup, an early stage company, this is a really good area to be, because if you're in biotech, you probably know more than I do, like the Philly region is one of the biggest biotech areas, but that gets pulled up here as well. That's what I'm saying. It's a much larger, the New York ecosystem is way bigger than people, I think, imagine. And then we have a lot of great hospital systems in the area that, allow you to work with them and validate what you're working on. And you certainly have HITLAB. So there's a lot of resources here in this ecosystem that you don't see, I think, in other areas of the US, perhaps.
I can add to that too.
Yeah,
I think, going back to the academic research, I mean, this is, the largest kind of aggregation of academic institutions, largest amount of funding, largest amount of principal investigators working on a lot of translatable problems that, out of the clinic or out of an early research lab. You have this growing base of kind of, I would say, operational talent within startup companies, as well as many of the bigger companies are, kind of commercializing themselves. Folks are rolling off there to looking for their next startup opportunity. So I think that's key to be able to get those operators in that are subject matter experts with you as well. And I would say to one of Bill's earlier points, in terms of risk capital, traditionally they've been focused in more of the biomedical areas. I think a lot more risk capital is coming to New York and not only just base themselves here, but looking to invest here, which is, I think, pretty different than what it's been over the past 10 years. And I think a lot of that is because the infrastructure as a whole has actually elevated the ecosystem.
Gotten better. And to give a shout out to my hometown, because you mentioned Philly and pharma, Boston is up the road and, not a long drive away, and a pretty good biotech hub. So being in the Northeast does have its advantages because, you're within driving distance and to so many great institutions that can really help you. For both of you, and I ask this question a lot of investors, and it's always interesting to hear the answers I get. But when you meet with a startup, a founder for the first time, and they're making their pitch to you, what are those qualities that you're looking for, that you're looking to see, like, yeah, this is a company I could see investing in? Michael, why don't you start?
How much time do we have? So, I mean, the first and foremost thing for me is I think it's really important to be able to tell a story. And I'd say that I know that's a big, kind of big idea or big concept. I think a lot of early stage companies, particularly in our industry, are founded by technical founders, and they want to get into the details of the technology, which is wonderful. We want to know that. But someone who can understand those kind of technical details, but also frame the company in terms of, okay, what is the technology itself, or what is the problem we're trying to solve? What is the solution? Why is this company that you're developing, the company to provide that solution? How is it competitively differentiated? Do you have a clear path if there's intellectual property or not? And then kind of in this day and age right now, is your financing and business strategy actually realistic, but also fits within whatever niche of the industry that you're involved in, or will that financing and business strategy actually help you hit commercial milestones? And then I do think it's extremely important, I know people talk about this all the time, but bringing the right sets of people around the table with you, and it doesn't have to be full-time, particularly for early stage companies. Certainly, there's ways for folks to be advisors, to be on your board, to be a scientific advisor board, to be a consultant. So creativity around how you're getting folks involved who have the relevant sets of experiences and network to help you get there. I'm looking for those kind of, big elements.
Yeah, Bill.
Yeah, we have similar ways of looking at it. I mean, the narrative is extremely important, as Mike said, and we're also looking for assets that bring disproportionate value to the healthcare system, and it's combined with what kind of use case are they trying to solve, and is that use case worth solving within the healthcare industry? Because not all of them necessarily are. And then, is the company financeable in the sense that is it actually a viable company from the standpoint, is there a market? Do we think there's reimbursement or somebody that's willing, to pay for it? And can we actually, with the right syndicate, build the right kind of company that brings that disproportionate value to the healthcare system? And of course, from the C-suite or whatever employees there are, do they have, experience? One of the things that I think we don't like is when they don't understand. Healthcare is one of the most complex industries. When they don't understand how healthcare works, when all the touch points are, that's a red flag in a sense. If they don't understand the regulatory pathway to whatever it is they're building, what that is, that's a red flag. So it's making sure that they understand this industry. I think that's an important piece of what we look for, because it's such a complex industry.
You read my mind, because I was going to ask you about red flags. So Michael, what are some red flags that when you hear them, and maybe you've heard them a lot, that make you think, you know what, this founder has a little bit to learn before, we would work with them?
Yeah, so maybe I'll answer in two parts: the company itself and then the founder, because I definitely think they're different. So on the company side, I totally agree with Bill. I think what we see a lot in many of these pitches is, incremental innovations, right? So for an early stage venture firm to get excited, we're looking for the big innovation or something that's going to have a massive impact, on the healthcare system, not just some sort of increment. I was talking to a company that had like a 5% increase in over standard of care, and the standard of care was had a 30% success rate. So that's not going to be enough. That I'd say is something that would get us excited. The second, and I think it's it's unfortunate, sometimes you see a lot of folks coming with projected business opportunities of kind of revenue targets that aren't maybe large enough, right? And maybe in the tens or hundreds of millions, not the billions for therapeutics. So markets I think are important for us in terms of how you're thinking about the total addressable market. On the founder side, I think the storytelling aspect is huge. What I will say is the ability to accept feedback and be open to it and evolve as you're hearing it. Whether it be in real time or be able to take that feedback back, digest it, and come back, as well. If we're not seeing that, that's kind of a telltale sign of somebody who maybe isn't coachable, isn't really listening, isn't kind of aware of their surroundings, taking information, and isn't going to be able to, make adjustments on the fly in real time.
For both of you, and it's impossible to predict the future, but I'm going to ask you to do it anyway. What does the future of venture capital look like? Bill, you had mentioned the valuations from a few years ago, just completely unreasonable. We've gone down from that. Where do you see it in the coming months, coming year? And is it going to get better? Is it going to stay the same? I'm curious what your thoughts are.
Yeah, I think it's going to get better. I think one of the things also we look at as a growth investor is we look at this as opportunistic, because it's a great time to potentially, and this is where the private equity firms are really moving fast right now, is a chance to consolidate assets together, right? Because when these companies had raised at high values, there wasn't anything necessarily wrong with the company, but if you can take two good companies and put them together and create a better company, that's a great opportunity. So we look at that as really a positive way to move forward. And we see that the fact that the A rounds and B rounds and the startups are all getting funded, if they don't exist, and I don't exist as a growth investor. So for me, I see lots of opportunity coming my way because these earlier assets are getting funded. So I have a really good outlook on where the market is. Everything's cyclical in this business, and we'll just have a slight downturn. It's not going to last as long as people. I think towards the end of this year, beginning of first quarter, we should start to see the IPO market open up again. Investors are coming back. They're done retreating. LPs are putting money back into venture capital firms. So there is capital to deploy, and I think it was just a small retreat for the last 12 to 18 months, but I have a really positive outlook on where venture's going.
Do you have any additional thoughts?
Yeah, so maybe I'll speak to it on the early stage side. So we think this is a fantastic time for early stage investing for a lot of the reasons Bill had mentioned, kind of more reasonable valuations. I think you're seeing companies that have used funds to be able to de-risk things farther down the value chain, and I think that's for us, that's kind of de-risking element to things, but then also not have these valuations increase a ton. So we're really active right now. We're kind of at our normal pace. I do agree with Bill. I think the companies maybe that got out in front of their skis with larger valuations, raised hundreds of millions of dollars, are going to have trouble finding the right sets of investors for them to continue. There's going to be some consolidation there. I think it's unfortunate, but I also think it's an opportunity for early stage companies because you're going to get a lot of talented people who are rolling off those companies that are going to be looking for their next opportunity. And we're advising companies we're investing in it at the early stage to raise funds for a solid 2 years, so you can hit those milestones, get to 2020, late 2024, 2025, when markets should be better for all the reasons Bill had mentioned. But then you're also going to be able to attract the right level of talent that's rolling off these companies. So we're really excited about the current state and what's to come in a few years.
One last quick one, because I know we're running short on time here, but is there anything we can learn from what happened 2 years ago with the high valuations and kind of a funding market that proved to be maybe a little bit unsustainable?
I think from the investor's point of view, more discipline, right? Because there was so much money flowing into healthcare that the money just had to be deployed. So I think there was a lack of discipline and really evaluating the companies, doing the due diligence that's necessary and having that discipline. So I think that's a good lesson learned, that from the investor side, we need to maintain that discipline and do the kind of work we need to do in order to evaluate a company in the right way.
Yeah, last thing I would just say is not every science project or is actually a company. I think that's just true. So to Bill's point, I think more de-risking work done by the founders or in the academic labs early on to hit those. And I just don't think we're going to see as many like back to the napkin startups, if you will. And I think that's good for everybody, to be honest with you. So increasing the bar, if you will.
Is that part of the feedback sometimes?
Sometimes the answer is like, hey, this is really interesting science and really interesting research, but unfortunately, I don't know that it's commercializable, right? Yeah. And that's okay. That's part of this business.
Absolutely. Well, Michael, Bill, thank you so much.
Thanks.
Appreciate it.
Thank you.